Alright guys, welcome back to the channel. So we've got a lot to cover today, and things are only getting messier. A week ago, Western automakers reported poor results. Renault and Stellantis experienced at least a 35% drop in revenue. The stock price dropped by more than 18%. Nissan also revealed a surprising quarterly earnings fall. And here's how insane the fall was. Nissan's profits fell by 73% in the latest quarter. Although forecasts were 98 billion yen, the corporation only made 29 billion yen in profit. If you build and sell cars, you cannot ignore the world's largest market, China. Last year alone, they had approximately 26 million auto registrations, and rise of 11%. The domestic market is booming. Demand for automobiles is increasing, but there is a minor issue. Chinese consumers simply aren't buying Western cars. BYD, Geely, NEO, and all of the other local brands are engaged in a vicious price war. And as a result, automakers in the G7 are unable to compete. There is just so much you can reduce your price. Chinese enterprises have fewer overheads. I spent hours of research on these topics just for you, so buckle up because this is going to be a wild ride. I am sure you'll find these breaking news and updates very intriguing and interesting. This is Earth Economy Explained. Western automakers prioritize earnings and keeping stock prices high for stockholders, and their worst nightmare is a price war in China. Brand loyalty and equity are the only advantages that Western brands have in competing. However, that will be insufficient to survive on the streets of Beijing or Shanghai. As we progressively approach a recession, people, including China, simply do not have enough money to spend. Consumers will be hyper-focused on affordability. This next chart serves as a wake-up call for premium brands. German car makers are struggling in the Chinese market. Volkswagen, BMW, and Mercedes all saw their deliveries decline by 8 to 10%. The real fear, however, comes from Porsche. Sales of luxury brands in China fell by an astonishing 33% in the first half. Remember that this is happening at a time when vehicle sales in China are on the rise. As a result, Western brands are being avoided, with luxury cars suffering the most. Even the affluent are trimming back. This creates a major challenge for the businesses. Exiting from China essentially ensures an impossible comeback. Local brands will receive fees based on their market share, but where else can they sell? They must return to their home markets and adopt protectionist policies. That is why we see all of the trade barriers rising from the ground. The EU tariffs and the 100% tax on China EVs in America are all attempts to defend their markets, which are a result of their failure to compete in the Chinese market. When every carmaker manufactures products in a factory in Shanghai or Shenzhen and has access to the same supply chain, it becomes the standard. Even Japanese automakers are abandoning Chinese production. Even in China is no longer advantageous. It's simply the norm now. If you do not do it, you will lose. Since 2022, 3 major Japanese manufacturers have reduced production levels. Toyota, for example, reduced manufacturing from roughly 900,000 automobiles to 650,000. In 2 years, they produced 25% fewer automobiles since there is little market for non-Chinese brands. Market share is being taken up, forcing them to sell in new areas. But here's the problem. If American, German, and Japanese automakers all focus on the same few anti-China markets, they will face a similar challenge. If extra G7 supply hits the US and EU markets, another price war will ensue. It may not happen this year or next, but it will happen eventually. Companies limiting Chinese production creates another issue. Manufacturing outside of China will reduce their automobiles' competitiveness, especially when exporting to other countries, places such as Asia and Latin America. Western brands simply lag behind when it came to EVs. A new analysis has been released, and it appears to confirm the extinction of conventional automakers in China. In China, electric and plug-in hybrid vehicles now account for the vast majority. Over half of all sales are EVs. Yesterday's news focused on gasoline-powered vehicles, and if you can't develop an affordable EV, demand for your brand will plummet, at least in China. Whether it's Ford, Stellantis, or Volkswagen, the majority of their sales in China are conventional vehicles, and Their inability to move quickly will result in a significant loss of market shares. Something significant happened last year. In China, electric vehicles are now officially cheaper than traditional combustion engines. This is the outcome of a breakthrough in inexpensive batteries. Compared to hybrids and ICE vehicles, the average electric vehicle costs roughly $32,000. That's a $2,000 save. This is a really big milestone. So Chinese EVs-AR only competes in that category. They are aiming to win the whole domestic car market. That's awful enough. However, China has set a 2030 target of 40% EV sales across the country. And because domestic consumption remains a concern, the federal government has unleashed a new round of subsidies. Consumers who switch from traditional to electric vehicles will receive a monetary incentive of twice the original amount, from 10,000 RMB to 20,000. That's approximately $3,000 in subsidies for the average citizen. This makes EVs even more inexpensive and ICE vehicles less appealing, so the pressure on Western brands, particularly US brands like General Motors, is significant. Their petrol-heavy lineup will gradually fade, so don't expect huge gains anytime soon. Before we proceed, if you're liking the video so far, please consider smashing the like button, subscribing to the channel, and hit the bell icon. Now let's go back to the exciting topic. But let's take a quick look at Japan, where the BOJ has recently made a significant shift. We kept hearing the same old refrain from Uchida and Kishida. Tokyo was closely following the weekly yen. The declining level of life posed a significant threat to the Japanese economy. But following the massive meltdown this week, the BOJ tossed out the old script. To hell with the yen. It is more critical to address the systemic risk of the whole banking system and keep global markets from collapsing. In a speech, Uchida confirmed that no more rate hikes are planned. He stressed the importance of continuing to ease monetary policy with existing interest rates for the time being. Capital markets are tremendously volatile, both domestically and internationally. In other words, Japan is scared that the carry trade would unravel and destroy everything. We do not know how much yen was borrowed and exchanged to buy overseas assets. We know that Japan's foreign investment has skyrocketed since 2021. It is currently worth approximately 500 trillion yen, 3.4 trillion. If the yen strengthens further, will Japanese investors cash out and change their dollars back to their own currency? That's the big question. That is the major risk for global markets. And it appears that the BOJ simply gave in to the pressure. They will not raise interest rates anytime soon. That is why we are holding a relief rally everywhere. The Nikkei recovered by 10%, Asian equities rose, and the S&P recovered by 2 to 3%, and they most likely had no option. According to Deutsche Bank, the Japanese government is sitting on an absurd carry trade. They have a balance sheet worth 2 trillion or 500% of total country GDP, which is ridiculous. They just cannot afford the BOJ's exorbitant interest rates. It will require Japan's government to begin paying interest to bondholders, causing the country to lose even more money. Second, it causes their own carry trade to unwind further. The BOJ oversees the government's liability side of the balance sheet. Since their liabilities exceed their assets, 301% versus 194%. If interest rates rise, their overseas assets will be hit by the carry trade, unwinding their foreign stocks and bonds, which account for 54% of their total holdings, will be a complete calamity. To keep everything under control, the Bank of Japan announced that it will not raise interest rates. They simply cannot. They must continue the carry trade for an extended period of time. However, there are implications to this. The release valve will be used as the currency, the Japanese yen. Unless the Fed suddenly comes out with large cards, the yen should continue to decline below 160 or even lower. Saving the world markets is only a result. Japan does not wish to ruin its own asset holdings. They are aiming for a beautiful deleveraging in which the yen gradually loses value. They might get it. However, if the United States has a recession and the Federal Reserve is obliged to cut interest rates quickly, the yen carry trade will still unwind. A big sell-off of assets purchased with the borrowed yen will still occur. So if you want Japan and the rest of the globe to have a gentle landing, America must avoid a recession. I do not want to be all gloom and doom here. I hope we can all avoid a recession, but all of the indicators, including the yield curve, are flashing red, and these indicators have yet to be proven incorrect. If you're talking about tail risk, the ultimate one is building in the Middle East. We can't ignore this. Iran and Israel are on the brink of war. It's so crazy that Blinken warns both parties not to escalate. He is justified in his fear. No one should intensify the conflict. The momentum towards a clash may be inexorable at this point. Russia consults with the Iranians. The United States is investing heavily on Israel's defense. As a result, tensions are surely rising by 100%. It is critical that we recall Lloyd Austin's guarantee of ironclad US backing to guard against Iranian threats. So it's very conceivable that America will be drawn into this mess, and the situation will escalate into a full-fledged war. We know that the Middle East is a strategic region. 30% of crude oil flows via the Strait of Hormuz, which is located near to Iran. And the Suez Canal and the Red Sea are also under threat. It is critical that we recognize that global oil demand is declining, and we only need look to China to see this. They are the largest consumers of crude oil. Their shipments dropped to 10 million barrels per day in July. Why? Because the world is slowing down and people are consuming less. As a result, China produces fewer goods and consumes less energy. In aggregate, China's oil demand is an excellent indicator of global consumption. Economic demand is another reason why oil prices have recently dropped despite increased tensions in the Middle East. So, if a physical war breaks out and the energy supply is literally cut off, the economy could plummet. Let's revisit an old chart from last year because the potential of a full-blown confrontation is now extremely real. So what are the economic consequences? We are currently in the doomsday scenario of a direct conflict between Iran and Israel. And of course, this will spark instability throughout the Middle East. The Arab states are in panic mode. If all hell breaks free, oil prices might rise by more than $60 per barrel. Inflation will increase by 1.2%. And get this, the GDP will decrease. Global GDP will decline by 1%. This is dangerous, especially given that the US economy is already weakening. A $60 increase in oil prices will undoubtedly cause a crash. A jump in inflation, combined with high interest rates, will tip the global economy over the edge. The headwinds are really incredible, folks. We just had a major stock market fall. Unemployment is rapidly rising, and the Middle East is on the brink of war. Putin himself has called on Iran to limit its strikes and exercise restraint, but this can easily spin out of hand, so hang on people, things might become a lot worse. And with multiple fronts colliding at the same time, the US-China trade war will break out soon. The yen carry trade will continue to unwind, and the Middle East is on fire. We are caught in a no-win situation, but as always, please let me know what you think. Is it over for Western vehicles in China? What will happen to Japan? Will the Middle East flare into a greater war? I hope you find this update very informative and helpful. Thank you for watching. Share your thoughts in the comments below. If you found this video insightful, please smash that like button, subscribe, and hit the bell icon to stay updated. As always, stay safe and stay informed. Thank you for watching Earth Economy Explained.